I think we're seeing some very positive trends in our business, and that gives us a lot of enthusiasm. First off, as debt capital markets have recovered and the stock market has recovered, we're seeing IPOs restart, we're seeing the M&A market restart, and that's obviously a positive for us, both for deploying capital and ultimately for realizing on some of our investments. The other positives out there are a real pickup we've seen in private wealth. There's $80 trillion of individual investors who could allocate capital to alternatives, and today it's a very, very small fraction who have. And we think that sea change is just beginning. I'm sure you've heard there are a lot of mixed signals on inflation. Now, the pace of inflation coming down has slowed, but we're still seeing input costs that are flat year on year. We're seeing apartment rents that are pretty flat. We're seeing wages come down from 5% a year ago to about 4% now. So we think ultimately the Fed will get better data on inflation that will give them the ability to cut rates. But for now, there's high uncertainty, and that creates opportunity. We think there is a structural shift in private credit. If you look at a traditional investor 60-40 portfolio, 60% public equities, 40% liquid fixed income, over the last 30 years or so, when you look at the 40, that stayed almost all liquid. And yet there's an opportunity by taking on some illiquidity to earn a higher return, just as we've seen on the equity side. So AI is coming to a theater near you. It's going to be revolutionary, but there's going to be a need for a physical infrastructure that makes AI possible. We've got $50 billion of data centers that we own or are under construction, and we're working on another $50 billion. One of the challenges in emerging technology is to try to pick the winner. But when you provide the infrastructure, the rails for something like this, we think it'll pay huge dividends for our investors.